All right, so let's talk about, we've talked about the income statement and balance sheet. Let's talk about the third financial statement, the cash flow. Not surprisingly from its name, really measuring cash generated or used during a particular period of time, whether 12 months or a 3-month period or what have you, and really a bridge between the income statement and the balance sheet. All right, based on accrual accounting, you'll have some timing differences in cash. The cash flow statement will reconcile that and is usually set up in 3 different sections. The first section we'll see is cash from operations. All right, so our cash from operations section starts off with net income. So the last line item on our income statement, net income. And to that, we're going to add depreciation and amortization, and then any other non-cash charges. All right, remember, source for depreciation and amortization always from the cash flow. This is where you're going to take it. Sometimes that's where you're going to source it. Sometimes that's broken out separately. That is depreciation expense, amortization expense, but you want to get both of these from the cash flow statement. Okay, you might see other non-cash charges during the year. You might see plus or minus any non-recurring gains or losses, non-cash gains or losses on sales of assets or what have you. All right. You'll typically then see plus or minus something called changes in working capital accounts. Changes in receivables, changes in inventory, etc. during the year. All right. Anybody ever hear the term that a company can grow broke? Basically what we're talking about there is usually, we're usually speaking from a working capital perspective. Companies that are growing, particularly asset-intensive companies that have a lot of inventory or maybe a lot of accounts receivable, as they grow, that can tie up a lot of their cash. So the company might be generating a lot of sales, a lot of growth in its revenues, but because they have so much cash tied up in their working capital, they end up going broke. They end up being cash flow insufficient. All right, so changes in working capital accounts are measured here, things like accounts receivable and inventory. All right, to the extent those items are growing during the year, is that a source or a use of cash?
Is that why companies will leverage their accounts receivable?
That's why they'll borrow against their accounts receivable and inventory to get that cash out now. All right. But to the extent that receivables, inventory have increased during the year, would that be a source or a use of cash? It's a use of cash, right? If a company's buying inventory, for example, they're probably having to write a check. They're probably going to have to fund that somehow. A lot of times that can be a use of cash. Conversely, if they've got accounts payable, they can borrow from their vendors. So in other words, instead of buying inventory with cash, I can tell them, I'll pay you later. That would be a quote-unquote source of cash, would appear as a positive on our cash flow statement. All right. Whole cash flow statement is listed in terms of positives and negatives. Positive numbers are sources of cash, negative numbers are uses. All right. We'll go into a lot more detail on changes in working capital, but I just wanted to introduce the difference or the concept of sources and uses of cash in the working capital context. All right, so that'll be, we'd add all those items up, would give us cash from operations. Next section would be cash from investing activities. All right, what's a common investing activity that you'd see? Things like capital expenditures, additions to a company's plant, property, and equipment. So going out and buying more buildings, going out and buying more delivery trucks, going out and buying more computers, furniture, fixtures, etc. All right, so additions to the company's fixed infrastructure, referred to as CapEx. And I list it in brackets because it would be a use of cash. Companies buying stuff, they're writing a check for it typically. Or maybe they're financing it another way, but that increase to plant, property, and equipment is listed as a use of cash. Purchase or sale of maybe securities. That type of thing might fall under cash from investing. Companies acquiring other businesses, acquisitions would be listed there as well. All right, we add all those together would be our cash from investing. And then our last section on the cash flow is cash from financing. Basically changes in our debt and our equity accounts. The company's borrowing, that's cash coming into the organization. All right, a lender is extending credit, they're giving us cash. So that'd be a source. If we're repaying debt, obviously that's a use. Okay, so plus or minus basically changes in debt, plus or minus changes in equity accounts. All right, so if we're selling more stock and getting cash in, that's a source. If we're buying back stock, treasury stock, that'd be a use. Okay, if we pay dividends, that would be a use of cash, etc. We'd add all those up, that would be our cash from financing. And our total change in cash for the year is going to be cash from operations plus cash from investing plus cash from financing equals total change in cash or total cash flow for the year. Make sense? So we basically just looked at all the possible inflows and outflows of cash. And if we add this total change in cash to our beginning cash at the beginning of the year, that gives us what? Gives us ending cash. All right. Which goes back up onto our balance sheet. It's that first line on our balance sheet. But basically, as we said, the cash flow statement reconciles the income statement and the balance sheet accounts to tell us, from a cash flow perspective, what has changed. And for us, the important items, all of these are important, but the most immediately relevant item is that D&A, source of depreciation and amortization, and we get it off the cash flow statement. So when you do your homework tonight, we're asking for EBITDA, you're going to get it from here. And again, cash flow statement, source of depreciation and amortization, gives us an idea of what's going on in the company's working capital accounts, its current assets, its current liabilities, and tells us overall how's the company generating, how's it spending its cash. All right, so a lot of times we'll look for trends in operating cash flow. That is the company generating more and more cash from its operations every year? Or maybe are its operations slipping a bit? All right, maybe its cost structure is going up. That would flow down and affect net income. Okay, maybe it's not collecting cash as quickly as it did from its customers. That would affect cash flow. All right, so those trends in cash flow, operating cash flow, trends in CapEx. Is the company spending enough to replenish its fixed infrastructure? You kind of think of fixed infrastructure almost a little bit like a car. Right? If you own a car and you never change the oil, never change the tires, never do those maintenance items to keep it running well, eventually you're going to be hit with a big repair bill at some point. Same thing goes for a company. If they're not maintaining their equipment, eventually the equipment's going to break down and cause them trouble in the long run, right? Okay, are they acquisitive? Are they paying with cash for acquisitions? And how are they doing with their debt accounts? Are they paying down their principal and their debt? Or are they borrowing more and more and more every year? All right, you might see cash on the balance sheet going up and up, but if operating cash flow is deteriorating and they're funding that deterioration through borrowing, eventually that can't continue. All right, if a company continues to get worse operationally, eventually the lenders are going to say no more, right? So those types of things you can assess by looking at a cash flow statement as well. Any other questions? All right, let's talk about normalizing the financials, and specifically what we're going to be talking about here is addressing those non-recurring charges that I talked about before. Okay? It is really not that difficult to go through a financial statement, take numbers off the hard copy pages, and put them into Excel. It doesn't take a whole lot of skill to do that. Where the analyst in an investment bank or a private equity fund adds value, truly adds value to the process, is figuring out from a sustainable go-forward basis, what can this company look like in the future? Where are those non-recurring items? Why have they occurred? How can we strip those out and normalize the company's financials to account for those things? All right, so this is where really an analyst starts to add true value in the process. And when we talk about non-recurring items, we're talking about things like maybe abnormal legal costs. Maybe the company got hit with a one-time judgment against them. They had to pay $1 billion settlement, but it settles the suit. They wouldn't have those expenses in the future. It works the other way too. Maybe the company got a huge inflow of cash because they won a lawsuit. Well, they're not in the business of winning lawsuits every year. They're in the business of maybe selling shoes or selling ketchup. So that those abnormal legal costs or inflows of cash we would want to normalize for those. All right, severance charges. A lot of companies taking severance charges this time or this stage of the economy. So mass headcount reductions, we wouldn't expect the company to cut half their headcount every single year. A lot of times those would be non-recurring charges. Factory shutdown costs, same thing. All right, to the extent that it's truly a non-recurring cost. Natural disasters, hurricanes, et cetera, man-made disasters. Sometimes you'll see asset impairment costs. A lot of times when you see an impairment cost, in many cases it relates to goodwill on the company's balance sheet. What's goodwill? When a company gets sold, goodwill is, let's say it gets sold to another company, goodwill is what gets created in that process to reflect the difference between the market value of that company's equity in the sale and the book value on its balance sheet. All right. Goodwill is a non-tangible, it's an intangible asset that would get booked on the acquirer's balance sheet. Goodwill can no longer be amortized. It used to be that we could amortize it, take a non-cash charge every year, reduce our taxes a little bit. We no longer can do that. What happens with goodwill is it gets tested every year by the accountants for impairment. All right, and to the extent that the company overpaid for that business it bought 2 years ago, maybe the value has declined, then the company would be forced to write down its goodwill, take an asset impairment charge. All right, and to the extent that that's a non-recurring item, we would add that back. All right, any profits, losses from sale of equipment, again, if it's not in the company's regular business isn't to sell its delivery fleet, or to sell all of its old equipment, or maybe sell a piece of real estate, that might be considered a non-recurring source of cash, or maybe a non-recurring loss if they have to sell it at a loss. All right, so we'd want to adjust for that. And then any integration costs associated with mergers. Okay. Does everybody, I'm going to talk about how we adjust for them in a moment, but does everybody understand why these types of items would be non-recurring and why we would want to adjust for them? Does that make sense so far? Okay. When we find these items, and again, we'll usually find these in the MD&A section. So to the extent that the company got hit with Hurricane Ike-related charges of $1 billion last year, and they took $1 billion charge on their income statement, it would probably be discussed in the MD&A section. It would be called out as a non-recurring or an unusual item, and that would be our first indication that we need to make an adjustment to normalize the financials for it. All right, so that's usually where you'll find it. And when we do find them, we have to make sure we understand when did it occur, and real importantly, in the income statement, where were they accounting for it? In other words, did that item occur, or did it appear in the SG&A number? That's typically where you'll see those items. It'll be in the operating expenses of a company. You'll see included in SG&A was a $1 billion non-recurring charge associated with damages we sustained from Hurricane Ike. All right, in 2008. So in that case, we've answered the question, when did it occur? Where was it in the income statement? It was in SG&A, so it was above EBIT, which means everything from EBIT and below is affected. And is it an abnormal expense or income item? Okay, and we decided that was an expense. Okay. So it's not always clear. Sometimes when you look at an MD&A section, they might talk about this year. Sometimes they might also talk about last year's results relative to the prior year. So you need to always make sure you understand when it occurred and account for it accordingly. All right. Whether it occurs above or below the EBIT line, again, that's important because if it occurs above the EBIT line, it means that EBIT was affected and everything below EBIT was affected as well. Sometimes you might see non-recurring charges, though, or non-recurring income that appeared below the EBIT line. All right? In that case, it would not have affected EBIT, it would have affected only those things that fell after it. And most valuation templates, when you're spreading financials, will give you the option. Did it occur above or below? And you need to make sure that you adjust accordingly. All right, and then finally, is it an expense or an income item? If it's an expense, and let's say it's an expense that was in SG&A, it affected EBIT. So in the case of my Ike example, what would that mean for EBIT in the financials? Would it have been over or understated by $1 billion? It would have been understated, right? If there was $1 billion charge, that means EBIT was unusually low by $1 billion. From our standpoint, we would add it back. And by adding it back, we would have, quote unquote, normalized to eliminate that item. Basically, to present those financials as though that item never occurred. Because again, we don't expect $1 billion of hurricane damage every single year. We view it as a one-time expense. And the opposite holds true for a gain. Say we win a lawsuit, we win $1 billion. We get $1 billion cash flowing in, we've got a $1 billion income item that's in our SG&A. That means EBIT and everything below, they were inflated by $1 billion, we'd want to back it out. Because we don't expect to win $1 billion lawsuits every year. Or have maybe $1 billion charges every year, maybe unless we're the tobacco industry or something like that. All right. Do these items make sense conceptually? Abnormal expense items get added back, abnormal gains get deducted. All right. And then obviously taxes are always impacted by anything we do. Okay, and the valuation template that we have will automatically calculate what taxes would have been absent that event. Right, you need to make sure you do that. So in other words, if EBIT should have been higher by $1 billion, the company would have had an additional $1 billion of taxable income. We would want to adjust the taxes as though it did in fact have an additional $1 billion of income. Make sense? All right, we'll show you how to do this in the valuation template tomorrow, but it's pretty straightforward. Okay, let's talk about financial ratios, and then what we'll do is introduce the homework, kind of outline some of the key concepts that you'll see whenever you work within Excel and investment banking. All right. So when we talk about financial ratios, these are ratios and figures that oftentimes need to get calculated when we're analyzing a company's strength or its liquidity or something like that. All right. And there are several different types of financial ratios. The ones we're going to talk about are liquidity, that is, how liquid is the company, how much cash or its ability to generate cash quickly if it needed it. Right. How much leverage does the company use? That is, how much is its debt relative to maybe its equity or relative to its EBITDA? All right. It tells us what does the company's capital structure look like. Activity ratios, how quickly is the company turning over its assets or paying down its liabilities. Profitability ratios, how profitable is the company. And then finally, growth ratios, how quickly is the company growing. All right, we're going to go through each of those in detail. All right, before we do that, I do want to talk about a couple items on the income statement, on the balance sheet, on the cash flow when we're setting up our models, when we're calculating ratios. Right. On the income statement, anytime we're calculating anything as a percentage of sales, maybe the gross margin percentage or the EBIT percentage, or a growth percentage, we'd want to set those up based on net revenues, not gross. What's the difference? Who can tell me the difference between gross and net revenues? Actually, it's way before we even consider taxes at this point. All right, gross might be, let's say you're a retailer, you sell a bunch of products, but every year you've got a few returns. All right, those net sales would be net of any returns that you've had during the year. It's typically, I think, the easiest example. And most of the time when you look at an income statement, the top line will already be net. Okay, so make sure you're working off of net sales. To the extent that operating expenses are broken out in a company's financials, break them out in your Excel template as well. You'll want your Excel model to match exactly what the company's financials look like in their hard copy form. So if there's 5 different expense categories, make sure you've got 5 in your model. Make sense? So break out everything that's been given to you. Again, operating income and EBIT, terms are used interchangeably. And don't lump interest expense and interest income together. Okay, most companies, if they've got some debt, they're obviously going to pay some interest. And with their excess cash, usually they earn a little bit of interest income on that as well. Okay, so at the end of the day, the company's operating accounts usually get swept into an overnight money market, and they'll earn a little bit of interest. It's like 0.1% these days. All right, so they might have some interest expense. They might also have some interest income. And what we're saying here is don't combine the two. Break them out separately. Make sense? On the balance sheet, obviously, assets has to equal liabilities and equity, the cardinal rule of accounting. So if your balance sheet is out of balance, whether you're spreading a company's financial statements or whether you're building a model of your own, this needs to hold true. All right, so in the homework, if you spread the balance sheet for Heinz and it's out of balance, probably means you either entered some data wrong or your formulas aren't adding things up properly. The balance sheet, we list accounts in order of their liquidity. Remember, we start with cash and continue down. Usually a company's balance sheet will already be organized like that. Make sure you set up your Excel template to be organized similarly. All right. Separate goodwill from other intangible assets. The distinction is that, again, goodwill can no longer be amortized. Other intangibles like patents, trademarks, etc., can be amortized. All right, so we want to separate those because of their differing accounting treatment. Long-term debt, as I mentioned before, should include capital leases. What's a capital lease? It could be basically what it's saying is the company is leasing a piece of equipment. That is, they don't own it. But at the end of that lease, typically what will happen is they'll have either the option to buy it or the ownership of that asset will revert to them. Kind of like if you've ever heard the term lease to own, usually with furniture, that type of thing. That would be kind of a capital lease. Right? An operating lease, the difference between an operating lease and a capital lease is in a capital lease, the company can keep the asset and the lease, the liability, on its balance sheet. In an operating lease, it's an off-balance sheet item. So a lot of times retailers, they'll lease a store, but at the end of the day, they don't own that store. So they're not going to keep the asset on their balance sheet. The liability is also it's an off-balance sheet liability item. All right, so make sure your debt includes capital leases, and in many cases, I think it makes sense to include operating leases as well. All right, because otherwise the company, if it weren't under an operating lease, they'd have to have some other debt instrument in there. So I like to classify those as debt many times. All right. Double check, I don't know what we mean by double check interest-bearing debt. We should double check everything, make sure our numbers are right. And make sure you break out treasury stock. And again, treasury stock is if the company buys stock back from its shareholders, holds it on its balance sheet, and later on it can reissue it or what have you. If it's broken out on the balance sheet, break it out in your model. So let's talk about these ratios a little bit more. The first category of ratios that we have, liquidity ratios. Again, this measures the company's ability to meet its short-term obligations, to meet its current obligations. A lot of times this is used by lenders to make sure that the company is paying off its creditors, it's paying its employees, it's satisfying its near-term obligations. Right? Obviously, if the company can't pay its vendors, chances are they're not going to be able to pay the bank, so the bank is concerned about that. Okay, so liquidity ratios, some common ones you'll see, you might see a current ratio, basically current assets divided by current liabilities, usually expressed in terms of 1, so it might be 1 to 1 or 0.5 to 1 or 1.5 to 1, current ratio. And then sort of a variation on that, a spin on that might be something called a quick ratio, where out of the numerator we back out inventory. All right. We do that because sometimes inventory takes a while to really convert it to cash. Sometimes it might be at risk of obsolescence, might be slow moving, that type of thing. All right. So absent the company's inventory, how well can it meet its short-term obligations? Make sense? All of these ratios, by the way, I think pretty much all of them, you're going to have to calculate in your homework. So when you're doing your homework, refer back to these last few slides. All these formulas will be useful later on. Leverage ratios. Again, when I talk about leverage, we're talking about the amount of debt a company has. Okay? With debt comes interest, as we know. With debt also comes what we call financial risk. All right? And generally speaking, the more leverage a company has, the more financial risk it has. Okay, so leverage ratios are geared toward assessing that financial risk. Again, oftentimes used by lenders, not only to assess risks, oftentimes to set covenants in loan agreements. What's a covenant? Absolutely, are keeping the lender's interests safe. So you lend me some money, you might say, okay, here's this $1 million loan, but every year I need you to maintain a certain level of interest coverage. That is, your EBITDA plus maybe some other income divided by your interest has to be above a certain amount.
So the debt service coverage?
So debt service coverage. That'd be interest coverage. Debt service would probably include principal as well. All right, but at the end of the day, the more easily I'm able to cover my interest, the better position you are as a lender.
There's a standard, though, out there, isn't there?
Oh, usually 1-to-1 is nice to see, right? But there can be differing standards from industry to industry. There can be differing standards depending what all is included in that ratio. All right, so you might have interest coverage. You might have something called a fixed charge coverage ratio. So you might say to me, Jeff, I want you to be covering your interest, but you know what? You got to be paying your taxes too, because if you don't pay your taxes, the government can come in and wipe out your interest as well. So you got to pay your taxes. I want to see you maintain your fixed assets. So I want to see you, doing CapEx every year. Oh, and by the way, all those working capital changes, I know it's an intensive business from a cash flow perspective. I want to see you covering your working capital as well. All right, and at the end of the day, I want that ratio to be above 1 or what have you. It's really going to be just a tool that the lender puts in place to make sure their interest stays secure. All right, so if my operations start to slip, I can no longer cover his interest. He's going to get concerned. That might be the first red flag telling us that we need to sit down and have a conversation. I need to make you feel better about the investment you made in the company. All right, so that would be an example of a covenant, basically a requirement that a borrower do certain things. Okay, there can also be negative covenants, basically requirements that the borrower does not do other things. Like, I can't go out and make a $1 trillion acquisition without your approval. I can't go buy a new factory without your approval. I can't take on additional debt without your approval. I can't give other people liens on my assets without your approval. All right, I can't fire the CEO without all those different things. And those are set up to, again, protect the lender's interest. All right, so the interest coverage ratio, you might also have fixed charge coverage ratios like we talked about before, covering taxes, other items, CapEx, working capital. All right, and then you might, if the company's debt, if the company's interest expense or interest rates aren't specifically stated, you can also kind of back into that by taking the company's interest expense and dividing by its total debt. Sometimes that can work if the company has a lot of seasonal borrowings, that is, the debt level fluctuates throughout the year. You might need to be careful about using that. But that's a kind of a quick and dirty way of estimating a company's cost of debt. Okay, activity ratios, again, activity ratios are going to measure how well is the company or how poorly is the company utilizing its assets, how quickly or how many times a year does it turn over its inventory, how quickly does it turn over its assets a year, how quickly, really importantly, how quickly does it collect from its customers. I can make all the sales in the world. If I can't collect any of it, from a cash flow standpoint, that doesn't do anyone any good. All right, so those activity ratios can be very, very important. It's also sometimes measured how quickly am I paying my vendors. Right? If I'm taking longer and longer to pay my vendors, a lender might say, well, that's not a good thing. That might be a hint that something's wrong in the business. If I keep stringing my vendors out, eventually they're going to do what? Probably going to cut me off. And that doesn't help anyone. All right? So these activity ratios can be really useful to measuring a company's health. We also will utilize these quite a bit when we build financial models. All right? So when we project out a balance sheet, One of the ways we'll project accounts receivable or inventory is to assume a certain turnover ratio or a certain collection period, that type of thing. All right, so we'll see these again, but the formulas again are here. Okay, who knows why we divide or we multiply by 360 instead of 365? Right, a year has 365 days. Why would we use 360? It's just because of easy math. Because 360 divides easily and evenly into 4. If you're doing quarterly forecasts, that can be helpful. No other reason other than that. Profitability, all right, again, measuring how profitably is the company conducting its operations. All right. How profitably is it manufacturing its products? So what's its gross profit margin? All right. How profitable is it from an operating income or an EBIT perspective? What about EBITDA? And all these items, anytime we say margin, we mean divide that item by sales, net sales. Divide gross profit by sales, divide EBIT by sales, EBITDA, net income. And we use these to compare the company to itself. Right, so what do the company's margins look like over time? If they're going down every year, that might be a red flag. We also can use these to compare the company to other companies in its industry. Actually, we can use all of these ratios to compare other companies in the industry. So who's the most profitable? Who utilizes its assets the best? Who's the least or the most levered? All right, so as bankers, as private equity analysts, we'll oftentimes look at growth rates. Okay, we can use these to compare one company to another. Faster growing companies a lot of times are valued more highly. Okay, we can also use these to build our model. That is, we're going to assume that this company will grow 5% a year for the next 5 years. Or they're going to grow 10% for the next 3 years, and then they'll become more mature and then maybe grow only at 5% thereafter. All right, so those growth rates can be used to build projections. And a one-period growth rate, easy way to calculate that. Period 1, in other words, this year minus last year, divided by last year. An even quicker way to do it is this year divided by last year minus 1. All right, so I'll put that up because we're going to use that a lot. I'll refer back to that as the one-period growth rate formula. Okay, so period 1 divided by period 0 minus 1.
That'll give you
a year-over-year growth rate, or period over period growth rate. We'll measure it for revenues, we'll measure it for net income, sometimes for EBITDA or EBIT. Basically, how quickly is the company growing? All gets back to Wall Street values growth. Right, so faster growing companies usually valued more highly. Okay, well, that's a one-period growth rate. We'll oftentimes look at something called a compound annual growth rate, a lot of times referred to as CAGR, C-A-G-R, which is basically a year-over-year growth rate. So when you're looking at something other than just one period to the next, maybe you're looking at a period of 4 or 5 years, what is the average annual growth rate from the start of that period to the end of that period? All right, so that CAGR is very important. The one thing I'll note, okay, if we want to calculate the CAGR on, let's say, revenues for each year, all right, I've got 5 periods, but in my formula, I'm going to raise this to an exponential power. When I select the number of years, in that case, what would my number be?
1.
Well, 1 divided by what?
5.
It's 5 periods. It's actually 4. All right, and that's the trick. That's what I want to point out. It's a very common mistake. It's 5 individual periods, but it's only 1, 2, 3, 4 periods in between. All right, so when you do your CAGR, make sure you've got the right number of years in that exponential power. Make sense? All right. So those are the formulas for the homework. What I want to do now is actually go back and introduce the homework. And you've got this in folder 1 of your course materials. what I'm going to open is the financial spread-Hines shell file. It's an Excel file, and you're basically going to be completing this file as part of your homework. All right, so this is what you're going to be working in tonight for homework. If you look down on the bottom, there's only one tab in this model, so all your work will be done right here. Certain models that we look at will have multiple tabs. The bigger the model, the more stuff we need to have. But basically, you're going to be doing a basic spreading exercise. You're going to take the financials that I've given you for Hines. You're going to pull out all of these items from the income statement, balance sheet, enter them into Excel. You're going to calculate latest 12 months, as we did earlier, using our formula there. And then at the bottom of this, you're going to calculate a whole number of activity, leverage, liquidity ratios using all those formulas we just went over. All right, so that's the basic exercise. Couple things I want to point out, though, before we jump into that. Number one, and this is going to be the case in pretty much all of our models, dollars are going to be in millions. All right, that's the decimal point convention that we're going to be using, whereas I think in the Hines financials, dollars are actually listed in thousands. Okay, what we mean by that, and I'll scroll down to the income statement in the Hines financials. If you're looking at the hard copy, I'm on page 37 of the hard copy. Let's expand that for everyone to look at.
Consolidated statements of income.
Consolidated statements of income. Okay, you'll see this every now and then in banking, where the company's financial statements are listed in thousands, but your model needs to be in millions. All right? All that's telling us is how we're moving the decimal place. So in this case, when we say it's in thousands, it means you would add 3 zeros on the end of this, and this 10,070,778 would become 10,070,778,000. All right. In this case, we're taking it from thousands to millions. So what would I do with the decimal point to express that in millions? I'd move the decimal 3 places to the left. All right. So in other words, when you spread these numbers into your financials, you would enter 10,070.778. Let Excel might round a little bit for you, but do not round. You enter every number that's given to you, you just move the decimal places accordingly. So you'll move it 3 to the left. Okay, so that's the first thing I'll note here. The second thing I want to note is a formatting convention. This whole spreadsheet has been pre-formatted to be consistent with what you'd see in investment banking. All right, if you go to the sales line, and I'm in cell I6, if you go to the sales line and you start entering in any numbers, you'll see that they come in blue. All right, but if you go down to I10, gross profit, and you start entering numbers, you see that that one is black. What's the difference? Why are some numbers blue and others black?
Has to do with some type of standard.
It is a standard. It's a standard. It's a modeling standard that gets used in banking and finance generally. Anything that's in blue is what we would call a hard-coded input. That is, we're entering a number directly into our spreadsheet. Anything that is black is what we would call output, or that it's referring to something else in our model, or it's a calculation. All right, so if I take Hines, for example, and revenues for 06, 8643.438, that's a number I would enter. I'm hard coding it. As you start doing your homework, if you enter numbers and it's formatted blue, it means you should be hard coding. Right? You're doing the right thing. If you start entering numbers and it starts coming in black, it means you need to be entering a formula. All right. So revenues, something that I hard code. Cost of goods sold, also something that I'll hard code. 0.364. All right. So I entered my cost of goods sold. Gross profit in this case is going to be a formula where I reference these two numbers to calculate this. All right, and that's something we do a lot in banking, especially when we build models. This blue and black really becomes helpful because if I build a model and I hand it to you to check it, you can tell just by the color of the font how I've entered that data, whether it's blue or black. And when we go back and we make changes to the models, we're going to want to change things that are blue, keep things that are black, leave them alone. All right? So input, output, very important. So for gross profit, my formula would be equals I6 minus I8. Right. Another way to think of this is anytime you see a cell that's where the text or the numbers are black, your formula, which is up in that F sub x line, should start with an equals. And it should be referring to other cells in the model. Make sense? Everybody see how I set that formula up? All right, because you're going to be doing that. And once you have that, you can actually copy things. You could copy that and paste it across, so you don't have to enter that formula 10 times over. Who knows how to copy and paste? It's the shortcut to copy and paste. Control C to copy, Control V to paste. All right. That's another thing that we're going to get more and more acclimated with are keyboard shortcuts. All right. If you've gotten comfortable using a mouse to select little icons up here, in other words, I don't even know where they are because okay, there's copy over here. Copy, and then you select your cells, and then you go back up here and select paste. All right, get away from using the mouse. It takes a tremendous amount of time. If you look how long that took compared to saying Control C, Control V, I saved myself several seconds there. And over the course of a model, over the course of evaluation exercise, that can happen thousands and thousands of times. Bankers work hard enough as it is. Don't make it harder by using the mouse. Right. The other reason is people will make fun of you in an investment bank if you don't use keyboard shortcuts. All right. So as you start doing these exercises, part of it is obviously to get the hang of spreading and where to put numbers and whatnot. The other part of it is getting used to using Excel, getting used to using the keyboard shortcuts, getting used to the syntax of things you enter in here. All right. So some people may have used a lot of Excel in the past, some people may not have. All right. People who haven't, this might be a little challenging at first, but take the time, use the shortcuts, and get used to it. All right. Any questions on this so far? All right. Now you'll see that we've got 3 fiscal years here and 2 interim periods. An income statement, or a 10K rather, in a typical 10K, what you'll see is you'll see 3 years of income statement and you'll see 2 balance sheets. All right, so that's all we're asking for in the balance sheet down here. Fiscal year ended May 2nd, 07. Fiscal year ended April 30th of 08. There will only be 2 balance sheets in your Heinz 10K, so you're only going to have to spread 2 of them. You'll have 3 income statements. You'll have to spread all 3. Now, if we open the 10Q, again, the 10Q will always give us year-to-date results since the last fiscal year end. Okay, so our 10Qs will give us this year's year-to-date. The most recent one that we have is for the fiscal year, or the year-to-date ended October 29th. We'll also have last year's year-to-date. Right, I want to open that actually real quickly and kind of show you a couple things relative to the 10Q. Again, you've got the hard copy so you can follow along. But if I look at my 10Q, got my cover page here. It says the name of the company. It'll tell me how many shares are outstanding, where they're headquartered, all those things. And typically a 10Q, the next thing you'll see after the table of contents, it'll go right into the financials. 10K, remember, has that business overview and MD&A and this and that. 10Qs go right into the financials. And in this case, you'll actually see that there are 2 different income statements. One is for the last 3 months, or the second quarter ended these days. The other is for the last 6, or the year-to-date period. Remember, these 10Qs allow us to calculate LTM. As part of the LTM formula, we need year-to-date. So you want to look at the longer of those 2 periods. All right, so of these 2 income statements, you'll pretty much disregard this one that's on, I think it's page 2 in the hard copy. You'll be looking at the one on page 3, the 6 months ended. All right, make sure you're working off the right one. It's pretty easy to make that mistake. Everybody, does that make sense? And once we have all the fiscal year ends, this would be the most recent fiscal year end. This would be this year's year to date. This would be last year's year to date. We've got all 3 pieces of data needed to calculate our LTM formula. So over here in this column, LTM, we'll take the fiscal year end, 4/30/08, plus our most recent year to date, minus last year's year to date. Same formula for each of those rows. Most recent fiscal plus most recent year to date minus last year's year to date. Make sense? Okay, the rest of the income statement, very straightforward. It's basically, we've set this up to be formatted exactly as the income statement is formatted in the hard copy financials that you've got. So you don't have to add any rows or change titles. All you're doing is entering numbers. Okay, and then down at the bottom of the income statement, you've got a line item or a few others listed here in rows 27, 28, and 29. That's where we want to capture depreciation and amortization each year or each period. Where would I get that? Cash flow. Always the cash flow. Once we have D&A, we can calculate EBITDA by adding that year's operating income, or EBIT, plus D&A gives us EBITDA. Right? Balance sheet, again, balance sheet also in millions, also set up to exactly mimic what's in the hard copy financials. All right, and that same blue-black coloring convention applies here as well. All right, so all of these individual items, they're all going to be blue. All right, and the subtotal line items will be black. All right, so total current assets would be black, total assets would be black, etc. All right, again, you only have 2 years of the balance sheet in the 10K, and really you're going to have, you'll have this year's balance sheet, or this year's year-to-date balance sheet. You'll also have the last fiscal balance sheet. All we need is the one balance sheet from the 10Q, and then really the LTM, it's not really such a thing as an LTM balance sheet. It'll be the same as the balance sheet in the 6-month ended statement. Okay, so this column, what you'll say is in each period you'll say equals the cell just to the left of it. They're the same. Kind of an odd setup, but that's the way it's set up. All right, again, balance sheet has to balance. All right, and then you get down to the financial ratios. All of these formulas are in your slides. You're going to calculate growth, your sales growth, EBIT growth, EBITDA growth, net income growth. All right, again, your one period growth formula is right here. And then you'll calculate the CAGR for the last 2 years, 2006 to 2007, then 2007 to 08. All right, liquidity ratios, leverage, activity ratios should be pretty straightforward. All those formulas are listed in the slides. The one item that I'll note is something called net debt. We didn't note that in the slides, but it is something you'll see from time to time. What is net debt? Who can tell me? It's usually debt minus cash. All right, and that's the calculation here will be, the numerator will be in parentheses, debt minus cash divided by EBITDA. That's all we're looking for. And so anytime you see net debt, it just means debt minus cash.